What's up, everybody? Dan again, Stocktrades.ca. Welcome back to the channel. In this week's video, I want to go over a very popular ETF in Canada, primarily because it is a dividend-paying ETF. It's a high-yielding ETF, and I have had a ton of requests on me to overlook this fund, see how it's done in the past, my overall thoughts on it, just my overall thoughts on dividend ETFs, period, and we're going to dive right into that right now. So in this video, we're going to be going over VDY, which is probably one of the most popular dividend ETFs here in Canada. But before we start, remember to head down below, subscribe to the channel, like the video, and drop a comment in the comments section. I'm going to be giving away a couple of premium subscriptions next week based on our hitting 16,000 subscribers. So thank you for that. And again, no BS newsletter down in the description. You can click the link there, sign up. It is a 2 times a week newsletter, absolutely free, no gimmicks. We're giving away stock picks, market insights, market strategies, investment commentary, news, all that type of stuff. So VDY, this is the Vanguard Canadian high dividend yielding ETF. And this is, again, like I said, one of the most popular ETFs in the country. It has a management expense ratio of about 0.22%. It's relatively low, but not super low like you'll see with a lot of US based and even some Canadian index funds. And it has a dividend yield of 4.48%. So this is why a lot of people like this fund. It's a higher yielding dividend ETF, and people use it to kind of have a one-click solution to generate income, own a basket of Canadian stocks that generates high levels of income. But has it been worth it over the last while? I'll get to that in a bit. So this is an index fund. It aims to track the FTSE Canada High Dividend Yield Index. Now, I would imagine this index is full of yield prioritized stocks, and we'll get to that in a bit with the total holdings. Now, in terms of assets under management, $2.471 billion. This is a pretty large fund considering we're in Canada. I mean, if any fund can break $1 billion in AUM, that's relatively strong. It has a pretty low turnover ratio, which probably means a lot of companies tend to stick within this index. There's not a ton of rebalancing. So overall, you're going to get the same types of holdings in this fund pretty consistently. If we go down to the number of holdings, it contains 53 total holdings. The weighted average price to earnings ratio is 13.32. So this is a relatively cheap fund. And in today's day and age, like high policy rates, a lot of these companies are probably high debt, low growth. I'm not all that surprised to see a price to earnings ratio this low, especially on the Toronto Stock Exchange. So we look at the return on equity, which is pretty strong, 13.29, return on assets of 2.67, forecasted dividend yield, which I believe is a forward-based yield. They figure the dividend yield is going to go up to 5.6%, and they figure forward price to earnings ratio is actually at 11.7. So there's no doubt that the 53 stocks inside this fund are super cheap. But when we go down to look at the growth estimates, you're probably going to realize why. So they estimate that 5-year earnings growth of this fund will be 4.83%. This is annualized. And if we head to something like, let's just go up to the S&P 500. Let's look at SPY's annual growth rate. And when you see this growth rate plus valuation, I mean, when we look to the price to earnings ratio of SPY, it's at 24.75. But when we look to the 5-year earnings growth, it's at 12.05%. It's 2.5 times, almost 2.5 times. I think my math is right. Bigger than VDY. Price does come with growth. The markets are forward looking. They're going to look at what a basket of stocks or an individual stock is expected to grow in the future, and they're going to base their price on this. This is how the market works. They value stocks based on earnings. They don't value stocks based on dividend growth. They don't value stocks based on dividend yield. They don't value stocks based on anything outside of earnings and free cash flow growth. The markets might be inefficient over the short term, but overall, stocks grow with earnings. This is something you need to understand moving forward. Now, forecasted earnings growth. This would be next year's earnings growth. They expect the 53 stocks in this fund to actually post a negative 1.88% earnings growth over the next year. If we go back to our SPY example, their forecasted earnings growth is around 6.97% next year. So we're talking shrinking earnings versus mid to high single digit growth. Now, this is not all that surprising. Canada is in a lot rougher shape than the United States. And when we head to the actual holdings of this fund, you're going to probably see why this fund is not expected to grow that much. When we look to the top, let's look at the top 10 holdings. We have Royal Bank, TD Bank, Canadian Natural Resources, Enbridge, BMO, Scotiabank, Suncor Energy, Manulife Financial, Canadian Imperial Bank of Commerce, TC Energy, BCE. What is similar between pretty much every single one of these stocks, maybe outside of Canadian Natural Resources? They're all very sensitive to interest rates. RBC, TD, all these financial stocks generally will benefit when interest rates go up, but right now the Bank of Canada is in a position where interest rates are so high that the economy is slowing, spending is slowing, borrowing is slowing. The mortgages are in a bit tricky of a spot here in Canada. They're facing a ton of, crazy renewal increases. Mortgage costs are fueling the vast majority of inflation. So as a result, the banks are having to put a lot of provisions for credit losses aside, which in turn impacts earnings per share. So although they're realizing possibly higher net interest margins from higher interest rates, those provisions for credit losses are impacting earnings. And as a result, the stocks are kind of not doing all that well over the last while. And when we look to companies like Enbridge, we look to companies like BCE, TC Energy, these companies are very interest rate sensitive, primarily because of the debt that they carry. They're very capital intensive businesses. They have a ton of maintenance capex. They have a ton of overall capital expenditures, and they have a ton of debt. I think Enbridge is something whopping like $78 billion in debt. It's absolutely nuts. So when interest rates go up, the cost of that debt goes up. Now, a lot of them will have fixed rate debts, different rates of debt, like different maturities on different types of debts. But there is no doubt that a higher policy rate environment is weaker for pipelines and telecoms. I mean, we look to BCE. They reported cash flows that are actually going to be lower this year than they were last year. And that makes a big difference right now because their dividend, it hasn't been covered by free cash flows for 3 years or so. This is the first time this has happened in nearly 20 years. It's pretty crazy. So BCE is trading at some pretty crazy lows. I mean, if we just look at the overall price of BCE right now, they've gone back to pricing we haven't seen since 2013. This is 11 years. Now, obviously, this is just price. If you had reinvested the dividends, as you can see here, we've gone back to just, pre-COVID pricing, maybe a bit earlier. But there's no doubt that this stock has taken an absolute beating, and it's primarily because of that dividend. I mean, when we look to the company's payout ratio, we're seeing 116% of cash flows being paid out to the dividend. The company was expected to trim back capital expenditures, get that free cash flow up enough to cover the dividend, but they ended up coming in lower than expected, and as a result, the stock is sold off. So it doesn't really get any better throughout this entire fund until we maybe hit Restaurant Brands International. That's not crazy cyclical based on interest rates, but the thing is, RBI does have a ton of debt, so even this company is impacted by interest rates. So I would guarantee you when we look at almost all of these companies over the last 1 or 3 years, we'll see struggling share returns. Maybe not Manulife Financial. I mean, Manulife Financial benefits a bit more from rising interest rates. But let's look at the overall performance of this fund over a 10-year period. So if we come to a 10-year period and we add in total return, which would be dividends reinvested, so you actually haven't even been able to benefit from the distributions received. You've simply had to reinvest them to get this return. It's returned about 113.3% over the last while. And if we show this in annualized values, you're looking at an annualized return of around 7.86%. Now, that on the surface isn't that bad of a return. If we add in the TSX index, you're going to see that it generally matches the index. It's even slightly underperformed the index over a 10-year period. However, when we look from a Canadian dividend ETF standpoint to something like SCHD, you'll see that the performance is drastically different. We're talking almost, a 4% difference in annualized returns. Like, this is a significant impact to your investment returns. And when we go to even the growth of $10,000 over the last 10 years, if you were to have reinvested your dividends, you're looking at just shy of $30,000 invested in SCHD. Whereas with the VDY ETF, you're at around 21.33%. So is a pretty material difference in returns. And that's even if we're focusing on dividends only. If you're just simply looking for the best total returning ETF, you could look to something like SPY, which would leave you with 33,300 based on 10,000 invested 10 years ago relative to VDY. So the performance has not been all that good. And the one big reason for this is rising interest rates. We head back to the main page here to highlight, just how interest rates have impacted this fund over the last while. We can see that in April of 2022, this fund hit pretty much all-time highs, and now it's effectively traded flat since. It's not down or up by that much. It's up a little bit, but relatively flat over the last 2 years. Now, what happened in April, May, June, July of 2022? Interest rates started to go up by a rapid amount. They went from, a quarter point to, what we're sitting at right now, over 5%. So ever since interest rates went up, this fund hasn't really done all that much. And you know what? That could be for a few reasons. For one, fixed income investments pay more than this fund. You can get a GIC or even a money market fund that yields more than this, and you don't have to take on the equity risk. So that's going to be something that a lot of risk-averse investors look to. And secondly, just the overall earnings growth of the fund itself has slowed. As mentioned, they're expected to post further earnings declines, and overall, it's just going to be a struggle for these companies in a higher rate environment. I mean, many people aren't very bullish on the banks, the pipelines, or the telecoms. So when we look to total allocations of VDY, we can see that it is a pure stock ETF. Like I said, it has 53 holdings. And when we look to exposure, it is pure Canadian. You're not getting anything else outside of Canadian stocks here. And when I see people holding VDY as a core portfolio holding, it kind of makes me uneasy because this fund is so concentrated, and we can easily see this in this chart right here. We're looking at financial services, Canadian financial services. This isn't even diversified financial services. You're looking at 55.61% exposure. Over half this fund is financial stocks, which is, like, if this is a small single position in the portfolio, not necessarily a big deal. But if you're forming this as the core of your portfolio, you are so heavily exposed to the Canadian financial sector, it's pretty crazy. And outside of that, we've got another cyclical industry, the energy industry, at 29.09%. So what do we always say about Canadian exposure, or at least I say about the Toronto Stock Exchange in general? It operates generally on three basic industries. We got materials, we have financials, and we have oil and gas. So there's no basic material exposure in this fund, primarily because there's just not a lot of solid basic material dividend payers. There are some, but not a ton. And we have, the remaining 86% of the fund being in energy and financials. So this makes up a huge chunk of the overall makeup of the TSX, and we kind of round it out with, a bit of utility exposure and a bit of telecom exposure. The one thing that this fund lacks, there is no technology exposure. Absolutely none. These are all old economy stocks. There's absolutely no exposure to new economy stocks like technology. Regardless of how expensive you think they are, there's plenty of cheap Canadian tech options here in Canada. It's got no industrial exposure, no exposure to the railways, no exposure to the garbage collectors, all that type of stuff. None of that exposure. It's got no real estate exposure to REITs. It's got no healthcare exposure, although this isn't really a huge deal here in Canada. There's not too many healthcare plays. It's got no consumer defensive exposure. So, the fund is naturally going to be a lot more cyclical. And when we look to the overall makeup of the style, this is a large cap value and a large cap blend fund. There's not very many large cap growth stocks in this fund. Like I said, they're all mature businesses, typically with high debt loads, low earnings growth. So As a result, they don't reinvest the capital back into the business. They pay it out as a dividend. So just a few things I want to go over in the fact sheet of the fund. When we come over here to the official sheet from Vanguard, we can see that the FTSE Canada High Dividend Yield Index is a market capitalization weighted index that is focused on dividend income. This is exactly why when we come down to the top holdings here, you can see Royal Bank, the largest company in Canada, Toronto Dominion, the second largest. It's going to take the largest market cap weighted companies that pay dividends and include them in the portfolio. That's pretty much it from the fact sheet that we've talked about. The only other thing I would mention, I guess, is the distribution. So we have to remember that the ETFs pay distributions, not dividends. You are not guaranteed to get an eligible dividend from an ETF. I mean, when we look to the different funds here, we can see, foreign income, foreign withholding taxes, capital gains, return of capital, all that type of stuff. Don't get confused that a distribution is going to be a dividend. It might not be. It might be a makeup of a lot of things. Now, for VDY, it looks as though it pays out strictly the eligible dividends plus a little bit of return of capital. So I'm not going to get into what return of capital is, especially because in this fund, it's literally fractions of a penny. Also, one thing I guess I should mention, this is a distribution from 2022. There's no 2023 information just yet. So this fund, for the most part, pays out eligible dividends. So $1.82 pretty much in distributions in 2022, and $1.82 was what was paid out. Now, this capital gains, I would imagine what is going on here is they reinvest those capital gains back into the fund itself. So it's not paying those out. There might come a time when it does pay them out, but I mean, for right now, this seems to pay 100% eligible dividends. But make sure you're checking the most up-to-date information, as you could be watching this video at any point in the future. Overall, I'm not a gigantic fan of this fund. It's absolutely nothing against Vanguard itself. It's more the fact that I don't really like these dividend ETFs all that much, especially Canadian ones. I mean, you saw me speak on the sector exposure of this fund. It's pretty much a financial and oil and gas pure play. I mean, if the oil and gas industry struggles, this fund is going to struggle. If financial stocks continue to struggle, this fund is going to struggle. Now, this is absolutely nothing against Vanguard itself. It's absolutely nothing against VDY itself. This fund has tracked its benchmark very well. It's done what it's supposed to do. I'm more so speaking on the overall strategy itself. And I mean, if you want to do it, it's totally up to you. I'm not here to say whether or not you should be buying these or selling these. I'm just going to provide my objective thoughts on these funds and whether or not, I see them as optimal. As a small individual position, I guess it makes sense. It's heavy weighting towards financial and oil and gas stocks isn't as impactful when it makes up a small percentage of your portfolio. But I see a lot of people putting a ton of money into this fund. And I mean, if anything, the thing you can take from this video is that, if this is a huge chunk of your portfolio, you are hyper-focused on Canadian financials and Canadian oil and gas, which, I mean, if that's what you want, I'm absolutely fine with it. Hopefully you can learn a bit more from this video to help you make a better educated decision as to whether or not you want to own it. So that's it for the video, everybody. Again, join the No BS newsletter down in the description 2 times a week. We're sending out unreal content. It's free to join, no gimmicks. You just enter your email and you're on the list. Thursdays, Canadian Investor Podcast with Simone. I'm talking earnings all the time. Our blog, Stocktrades.ca, we're providing a ton of investment content to over 1.8 million visitors in 2023. And I'll see you next time for more great videos.